Yeah. Hi, everybody. Welcome. Today, I have the real pleasure to be talking to Tom Woodhams from Craig Investment Partners. How are you, Tom?
I'm well, thanks, Bridget. Yourself?
Great. Now, it's a really important topic that we're going to be discussing today, and that's rebuilding financial stability after divorce, with a particular focus how Craig's Investment Partners investment advisors can help clients just like you regain control in terms of your finances. So, Tom, let's first of all talk a bit about you.
My favourite topic.
So you've been at Craig since 2016, eh?
Yeah, so I've worked in financial markets since 2002, both in New Zealand and abroad. And yeah, in 2016 was looking for, I guess you'd say, something a little more real. And the opportunity came up to work at Craig's. And since then, I've been working here largely in partnership with another advisor, Tanya Osborne, and we get a real satisfaction out of working with people and helping them secure their financial stability. Yeah.
Brilliant. Okay, let's get into the questions now. If anyone has any questions for Tom, we're going to be including his contact details at the end of this webinar. So as it says on screen, what are some of the financial challenges that people may face after going through a divorce from a financial perspective?
Yeah, it's a big question. And before I get into my answer, I do just need to get a little legalese out of the way, if that's all right. So please, if anyone watching this, if you can just remember that the information provided here is general in nature and it's not financial advice. And it doesn't take into account your situation, your objectives, your goals, or your risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, you should always contact an investment advisor. And you can find out more about what we do at the Craig's website, which is craigsip.com. But back to your question, Bridget, about what the financial challenges people might face after going through a divorce. Look, the obvious one is obviously the division of assets. People have built a life together. They have built a financial base together. Often one partner's given up their career or a portion of their career to look after family or raise children. And then all of a sudden you have this big cataclysmic event and you have to figure out how that division of assets goes through. And there's the hard sort of data where you've lost potentially 50% or even more of your net worth, and that's obviously very confronting for people. But then there's the sort of the niggler, more technical, more detailed parts that, if you're selling the family home, and then where do you live? Do both parties rent? Do you both try and look to buy somewhere? Does one buy? Does one rent? KiwiSaver or superannuation accounts, how do they get divided? Is that a 50-50 split, or do you need to negotiate some sort of some other skew to the split? And then obviously on top of all that, you've got the emotion of going through divorce. So, it's a big topic, and it can be an expensive topic, and it's where we try and help make things easy for people.
Yeah, wonderful. Yeah. So how can people like you help clients regain control of their finances after divorce, particularly in the current environment that people find themselves at the moment?
There's a couple of ways really, Bridget, and taking emotion out of it is a big part. Our big role as investment advisors, some people think we're here to pick stocks and the next winner. It's actually to remove emotion from the process. And divorce is such an emotional topic and such an emotional timeline for people. To have a trusted third party like ourselves is really key, and we can sort of help people step back from the edge, help them see the bigger picture, try and focus on what some long-term objectives might be, and then we can start building a plan on how we're going to get there.
Yeah. So what specific financial documents should clients bring to their initial meeting with an investment advisor?
Yeah, on the one hand, that initial meeting it's about getting to know people, and it's about getting to sort of dig down about what they're trying to achieve. But look, any information around, financial assets, if you've got an existing portfolio, what's in that, if you've got a budget written out and things like, the more the merrier from that financial document side. But at the same time, initial meetings are as much about getting to know each other and understanding what the client's after as it is getting into the nitty gritty. So
yeah, fantastic. So, what are some of the retirement planning strategies that advisors like yourself and Tania may recommend for clients?
Yeah, starting early is the big one. Look, New Zealand, typically financial education isn't great, and a lot of people don't understand basic concepts like compound interest and things like that. And every wealth manager will have their own specialty or their own approach on how they're trying to build wealth over time. With Craig's, we look to invest in shares and bonds in New Zealand and around the world. But in terms of the actual strategy, it's finding the right asset allocation for the client's risk tolerance and the client's overall objectives. And once you get that, a lot of things tend to fall into place. But yeah, it's certainly something you don't want to take lightly, but at the same time, you can over egg the custard, if you like, if you're not careful.
So question for you, in the current environment, are people more risk adverse? Are you finding that?
There's a bit of a mix. It does depend on the client and again, their circumstances. Some people look at volatility like we've seen over the last 18 months, 2 years as an opportunity. Other people go back into their shells and think the world's about to end. And then there's a few in the middle who've been here, done it before, and they know that this will pass. Again, we take the very strong view that everyone's different and everyone has their own worldview, and we have to try and build a portfolio or manage risk in an appropriate way for each client. So, yeah.
So how do you help clients identify their financial goals?
It's a lot of talking and a lot of questions and a lot of listening. We've literally had people walk into our office and say, I'm retiring in 6 weeks. What do I do? And, it's a little bit complicated versus people, coming in 30, 35, 40. And obviously retirement's a very long way away. So you've got to be flexible over time as well. But it is as simple as talking and listening and asking lots of questions. Okay, you like to travel. Where do you like to travel? How far do you want to travel? How long do you want to travel for? Everyone's different. So you've got to be able to cater for that.
Yeah. So, there's so much involved, isn't there? There really is. So you mentioned about shares potentially being an investment option. What other types of investment options would you suggest to a client who have been through a separation?
Yeah, as I said, every wealth manager has their own approach, and that's not to say that they are wrong. It's just Craig's. We take the view that shares are nice and liquid. You can easily research them. They're typically cheaper to buy and sell than other asset classes. So we like those as a core of every portfolio. And then we use bonds, which are a slightly different type of financial instrument to generate income and offset the volatility in shares. But it's the mix of shares to bonds and then what type of shares you recommend to a client. That would be very individual depending on their circumstances. So it's about getting that mix right as much as anything. But that's, not to say that other types of investments are bad or wrong. It's just that's the approach we choose. I think the big thing is clients understand what they're getting into and that the instruments or the investments being recommended are appropriate for their worldview. And a classic example of that in the current environment is, environmentally responsible investing is quite a big topic. So there's no point going to a manager that specializes in natural resource investing if you don't like miners. You've got to find out what's appropriate for you.
Yeah. So how important is it for clients to work with an investment advisor who's had experience with divorce scenarios?
Well, empathy is a massive part of our job. Again, we are part cat herder, we are part investment advisor, we are part counsellor. Our job is not just buying and selling and trading. It's there's a big element of hand holding with all our clients. So to understand divorce and the stresses that places on people is pretty crucial. But empathy should be a part of any decent financial advisor. Yeah.
So apart from the likes of, empathy and finding yourself, obviously being part counsellor through the process, what else should clients look for in an investment advisor?
Yeah, again, this is a great question, and I think you'll find there's a fair few resources on sorted.org if people really want to delve into this, but making sure that worldview matches up with the client view is pretty key. Again, if you're a environmental or socially responsible investor, there's no point going to a specialist in natural resources or anything like that. You want to find people who can relate to your worldview, but there's a few technical issues to consider as well. Like, is the wealth manager, are they well resourced? Do they outsource their research and their compliance? Is it done in house? Are the assets held in a third party custodian? Are they audited properly? What sort of reputation have they got? That's all part of it. But I think when it comes down to that one-to-one relationship, it's beauty contest is the wrong way to describe it, but it's that personal relationship. How do you get on with them? Do they listen? Do they have empathy? You can tell pretty quickly whether or not you're going to get along, and that is a big part of it.
Do you feel like you're being heard as a client?
Yeah, of course. Again, there's nothing worse than working hard for 20, 30 years and then you come in and feel like someone's not listening to you when you want to invest the funds, right? It's crucial.
Yeah. So you're building this financial plan for clients. How often should they meet you in terms of that? Is it on a yearly basis that gets reviewed, or 6 months? What does that look like?
Our process is to have 2 formal reviews each year. And one of those reviews is a bit more in depth, and you would specifically check that their investment objectives have or have not changed, whether their circumstances have changed, whether anything's changed with their risk tolerance. So that's sort of a big annual check-in to make sure that the current portfolio is still fit for purpose. And then we do another 6-monthly review where we would look at, say, rebalancing a portfolio if asset allocation skewed out of line or anything like that. But what we do find is newer clients need a bit more hand-holding, and that's perfectly understandable. It might be a new process for them, and we might talk to them weekly or monthly, depending on what the client wants. And then as they get more and more comfort with us and the process, the contact naturally sort of drops off. One thing I would say is, in volatile markets and the plethora of information you can find with regards to shares and trading and investing these days, there's possibly an over tendency to check your data or your portfolio too much, and people can stress themselves out in that circumstance. So you have to be careful and find the right balance, because equities are volatile in the short term, and there's no point worrying about the day-to-day movements. You want to be looking at the longer term performance.
So with any investment option, obviously comes risk. So how does your team minimise these risks for clients?
Yeah, sure. That's a great question. Obviously, very topical. Look, the biggest risk, I think, is a mismatch between risk appetite and asset allocation. And again, we have seen this a little bit in the last couple of years. Clients who joined up in the good times and they've never experienced a down market, all of a sudden realise they're taking more risk than is appropriate. So getting that asset allocation right at the start is crucial. Then, we'd obviously look to diversify our investments or the client's investments appropriately. And, we look to diversify by geography. So we invest in, different countries around the world. We look to diversify by industry sector. So you're not just invested all in banks, for example. You want to spread it around various types of industries. We diversify through asset class. That's the bonds and the shares. But you also want to think about things like liquidity. Can you get your money out in a hurry if you need to? And again, we really prize liquidity, and most of our assets, because they're listed on exchanges around the world, when you buy or sell them, settlements within a couple of business days. So, it's a term deposit, for example. If you want to break a term deposit, it's typically a 31-day break period, and a lot of people don't understand that. So while a term deposit is very safe from a risk perspective, it's not necessarily as liquid as other types of investments. So you want to make sure that you have that diversification appropriately. And again, that comes back down to your asset allocation and those hard questions we ask at the start.
So how do you help clients balance their short-term versus long-term financial goals?
Yeah, again, we see this quite a lot. People come to us with a lump sum, and they might say, hey, we've got, a few $100,000 and we want to invest, and, we want you to make us lots of money. We say, great. What do you want what are you planning to spend the money on? And they say, oh, we want to buy a house in 3 weeks' time. And, that's obviously a big mismatch in the time horizon of how we invest versus the time horizon of what they're planning to spend the money on. So it comes back to those questions, the asset allocation, understanding what a client really needs, what it is they're after. And look, we frequently tell people that our portfolios aren't appropriate for them based on what their goals are. So if you have those goals matched up correctly, our portfolios are a great way to go. But you've got to define the goals properly first. But it might be as simple as keeping a bit of cash outside the portfolio, or making sure you've got appropriate liquidity. Yeah.
So let's talk about tax. How do you, as investment advisors, help people navigate the tax implications after a separation?
Yeah, look, to be honest, that actually gets a little bit outside our area of specialty. And when we do start getting outside our areas of specialty, we typically refer people on to specialists. So tax we can talk about very broadly, but we would generally be saying, here's a great accountant we know. We should probably sit with them and they can talk you through it.
Yeah. Okay, great. So what are some of the warning signs that you see that a client's financial plan might need to be changed?
Again, it's that mismatch of risk tolerance to asset allocation is a classic one. So, markets maybe get a bit bumpy and all of a sudden you're getting a phone call at midnight from a client asking what's going on. That's a classic sign. And look, it might just be a case of, hey, let's take a little bit of money off the table and we can ride this out, or we just sit down and run through the portfolio and explain how we have diversified and just having that conversation. The other classic one we see is the cash flows, and a lot of our clients rely on their portfolios to supplement retirement income or day-to-day income. And if they're spending too much, maybe we need to have a conversation around budgeting or lifestyle choices and things like that. Or alternatively, occasionally they draw so much income off the portfolio and then they don't spend it. And it's like, well, hang on, do you need to be drawing so much income out? So yeah, the client will generally lead that one in terms of sentiment. If they're staying awake at night stressing, we probably haven't got the asset allocation right, and we need to have a conversation.
Yeah. Well, thank you, Tom. That's been really insightful today. And anyone who's thinking of retiring needs to come to you sooner rather than later is one of those key tips that you obviously talked about earlier in this webinar. Any other final words that you want to say to people who are navigating a divorce, whether that's starting at the process and the middle of it, at the end?
Just as with any sort of process, specialists help. It's hard when you're on your own, feeling like the world's against you and going through big changes, whether that's changing career, buying or selling a house or anything like that. Divorce, I can only imagine how emotional that can be for people. But the earlier you get that impartial third-party advice on board, the earlier we can help lift the load, and you're not alone. And it's just really important to get out there and talk to people. So, we're always happy to have a conversation and a cup of coffee and just start the process. But yeah, like I said, the earlier the better is, just easier for everyone. So yeah, please feel free to get in touch.
Yeah. And Tom's details are there, and he really looks forward to helping anyone who needs some assistance. So yeah, thanks again, Tom, for joining us. And we will be back with another webinar very soon. Thanks, everybody.
Thanks, Bridget.
Bye.